This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to the chart deck. Listeners, you'll find the download link for the Postgame chart deck in the Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the button over Lee's picture that says Looking for the Downloads. All right, Eric, let's jump into page 2. We have crude oil. What are you thinking?
EIA inventory was delayed by the Juneteenth holiday, so I don't have it this week. We've now bounced $7 off the lows, meaning that it's time to find out whether this rally has legs or if it's going to roll over like the last 14 rallies in crude oil did. I'll turn bullish above the 100-day moving average at 74.69 on WTI. But until we get there, I'm a skeptic only because of recent market weakness. I have been on board for quite a long time that when we start to challenge the limits of supply, prices are going to go through the roof. It seems like the market has been mostly focused on demand weakness as opposed to supply constraints. As long as that's the case, we're going to keep seeing these low prices. So I'm waiting to weather the recession is coming storm. We'll see what happens there. So I don't know if we're going lower first, but eventually I expect much higher crude oil prices.
Yeah, Eric, when we're looking at that chart, while it looks like we were up a large amount by percentage, technically there has been nothing significant that's happened in my mind. We still have a very important trade range that's in that $75 to $80 area that I, in my mind, view as the neutral zone on oil, which is the bulls have to essentially get it back up into those ranges to basically undo the prevailing downtrend that's been dominant for over a year, the sequential period of lower highs and lower lows and descending trend lines and below all the major averages. And we really need to see that downtrend broken in order for the bulls to have a chance. And really at this moment, we have not seen bullish price action yet. And if oil rolls over here, it's still vulnerable for retesting lows, and even under the right bearish conditions can even have a quick trip to 60, even though that's not necessarily what I'm anticipating. Point is that the bulls have a lot of work ahead of them still to turn this chart higher. Nonetheless, let's move on to equities. Eric, what are you thinking on this S&P here?
Despite the pullback early this week, the fact remains that the S&P broke out decisively above its 61.8% fib retracement level, and it remains well above that level right now. This leaves me with what I call crossed circuits. On one hand, I couldn't possibly agree more with the very smart guests who have warned us that the bottom is not yet in for this bear market. They make excellent fundamental arguments, and I agree with them. But there regularly comes a time in every fundamental analyst's career where the market is telling you that your view is just plain wrong. This market needs to either collapse back down below 43.09 and stay there, or else the technical signal is very clear. It says we're headed toward new all-time highs. Because the new technical signal directly contradicts what seems to me like bulletproof logic and reason with a more bearish fundamental view, I'm on the sidelines and plan to stay there. In the interest of full disclosure, I did try shorting this market, first at 43.09 and then adding to it at 43.60. I've subsequently been stopped out of that trade. You can't win them all. You win some and you lose some. I'm just waiting to see what happens. But if this rally continues from here, it really says to me that something's wrong with the fundamental view that I've been believing, because it's really not supposed to play this way unless the bear market really is ending, and I'm having a hard time believing that.
All right, Nick, I want to get you in the conversation because I know you're watching the S&P levels. What are the option levels you're watching?
Spot price right now is 43.65 on SPX. We have a call wall above at 4,500 and a put wall below at 4,000, which is also key support. Now, the implied move for the July 21st OPEX is 115 points in either direction. So the upper expected move is 44.80, just below that call wall. And the lower expected move is 42.50, which is also another support level. Again, key resistance above is at 4,400 now. Key support below is at 4,300, 4,250, 4,200, and then 4,000. I'm inclined to think that we see some sideways action perhaps into the July monthly OPEX. I also think we retest the highs, but I do think that we test out the 43.20 level, which is also the JP Morgan caller level for next Friday's June 30th OPEX.
Nick, it's interesting that you highlighted that JP Morgan wheel, because that's sort of what's on my mind here. Obviously, the magnet on the gamma magnet is at the 43.20 level, and I think that that's really going to be the story for the rest of June, which is essentially we had this big punch higher on the June expiry gamma squeeze, and now that much of that June expiry gamma has been rolled off, we now have a scenario where the markets are just going to mean revert and consolidate. It doesn't mean that into July we can't have another bullish impulse or some other type of a more volatile move. But really, for the next week or so, going into that June 30th, it really is likely that we're just going to mean revert back toward the 50-day moving average. I have it on page 4, and consolidate in the zone. And that's really, I think, going to be more of the story of the summer, which is maybe we go and retest the highs, we kind of bounce around, and probably whether it's the July earnings or maybe one of the jobs numbers in July or August, or maybe it pushes out to something like the Jackson Hole event. But inevitably, there's going to be a catalyst that is going to drive the next major trend move in the markets. But on the short term, it's possible that we're going to at least start the summer in some sort of a consolidation mode. Nonetheless, on page 5, we have the QQQs. What are you watching here on the NASDAQ?
The spot price right now on Qs is 362. We have a call wall above at 370 and a put wall below at 350. And the implied move for the July 21st OPEX is plus minus 15 points. So the upper expected move is 377 and the lower expected move is 347. Key resistance is above at 372, which is also the high from March of 2022. And key support is at 335. Now, again, I think that some tech names are pretty frothy right now, namely NVIDIA and Tesla. Tesla's already pulled about 26 points off of their highs in the last couple of days, but they've gained about $350 billion in market cap over the last month. So I think they're going to cool off for a bit. And as we've stated in the past, having 7, 8 names carry the weight of the market typically doesn't bode well when those names roll over a little bit or stagnate. So if we see NVIDIA and Tesla, among others, roll over, it's probable we're going to see a testing of the recent lows, perhaps, like not the lows for the past year, but I'm talking the 350 levels, 340 levels kind of thing. And that support area of 332 is very, very important. If we break below that, then it's possible we go back down to around 300 level, which is about 20% or so below the current price on the Qs. Now, I want to move on to the VIX on page 6 here. We're seeing new multi-year lows on the VIX, which is kind of interesting to see because we're seeing a pulling off of the recent highs. And you'd think that a decline in the market would coincide with a spike in the VIX, but that hasn't happened yet. So interesting to watch. Even yesterday when Powell was speaking in his testimony, the VIX was going down even as the market declined a little bit. So very interesting action to see right now. Again, with the VIX at around 13, 14, expected moves each day in the broad markets are about 0.8% or so. And we're seeing for the past couple of days that we've actually exceeded that at some points during the intraday market trading.
Interesting observation, Nick, because it's exactly that. There's clearly no imbalance in buying that is driving volatility premiums higher, and it maybe is demonstrating some complacency. But what is interesting on page 7, just overlaid the VIX with the VVIX, which is the volatility levels on the VIX itself when buying options. And so what you can see is that they are actually trading back up to April and May highs, which means that option premiums on the volatility are actually still being priced with a little bit extra premium. Maybe the market, while complacent right now, is messaging that some volatility is coming. It'll be interesting to see how that plays out once we get past that June 30th window.
Now on page 8, we have the US dollar index. What are your thoughts here?
No real change from last week. We're right in the middle of a wide consolidation zone. Only a daily close below 100 or above 105 would change that, in my opinion.
Eric, that trade range is exactly dominant. And but what is interesting to me is the divergence between Asian currencies versus Western world currencies, right? So while the Australian dollar has been somewhat okay, but the Canadian dollar, euro, and the pound have been incredibly strong. But when you look at the US dollar relative to the yen or the US dollar relative to the renminbi, they're moving the exact opposite direction. And there's these cross currents between the currencies. It'll be interesting whether or not they all converge and start to trend, because so long as that divergence exists, I think that the trade range will prevail. Ultimately, any US dollar bull impulses likely need some sort of economic cracks, and right now it just doesn't feel like that is what the market is worried about. So let's see how that develops.
Now on page 9, we have the gold futures chart. Eric, what are your thoughts here?
As I've been warning for the last couple of weeks, I think gold is poised for a deeper correction than we've seen so far. Last week saw the first daily close below channel support, and this Tuesday marked the first daily close below the 100-day moving average on the continuation chart. Meanwhile, Jay Powell is telling lawmakers that the fight against inflation is far from over. That means more rate hikes are coming. While at the same time, the dot plot predicts 2 more 25 basis point hikes in calendar 23. All these things perfectly set the stage for gold to make a deeper correction as the Fed continues to hike rates to fight inflation. When everything eventually breaks, and breaks badly, the Fed will start cutting aggressively despite the fact that inflation is still raging, and gold will soar. But until then, a soft patch for the yellow metal makes perfect sense on both technical and fundamental levels. My downside target is $18.60, which is almost $80 lower than the market was trading on Wednesday evening.
Eric, what's interesting to me is that up until April and May, the correlation of gold to something like the euro has worked very well, which is essentially gold has behaved like a cross currency to the US dollar. But what we've really seen at this stage is the euro and a bunch of these other currencies strengthen and the US dollar weaken, but yet it has made almost little to no impact on the price action of gold. And so this is a really interesting divergence. Right now, gold is behaving very much like it's being distributed, and it's coming to that key fib level. So it'll be really interesting to see whether this kind of 1925 to 1950 zone holds this consolidation. And you're bang on. I mean, if we see a break of the May lows really hold, 1850 or even the lows of March near 1800 unfortunately become short-term targets. I remain big picture bullish gold, but we're clearly in some sort of a consolidation and at some very key support levels. Nonetheless, I wanted to wrap up this week by talking about the grains, since Lee talked about it in the interview. I start off here with the wheat chart, and what's amazing is what happened just this week in the grain markets. We've been, since October of last year, in a very clear downwards channel of lower highs and lower lows, and a clear downtrend that has wiped out, 30-40% of the value of wheat prices. And what we've seen this week was a legitimate bull breakout in wheat. And it basically in 4 days wiped out several months of price action on the downside, and decisively advertising a potential new bull breakout. This will be really interesting to see whether or not this is actually a turn point in what's been a very distinct 9-month bear market. On page 11, I have the Invesco Agricultural Fund ETF, symbol DBA, which is a basket of agricultural commodity futures. And what you can see is that this is very distinctly bullishly breaking out, and we continue to see the agricultural space actually doing very well, and not many people are talking about it. And one of the reasons on page 12, when you look at the ag business ETF, which is the symbol MOO, which is the all those nutrients and mosaics of the world, they have been in a very distinct bear market and really have not begun to bull trend yet. The interesting question is, are we going to see the agricultural stocks finally come to life and start to trend the way it looks like that the futures are currently doing?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.